Hello, everybody. Hello, and welcome to Private Equity Rundown. I'm Bill, the company's expert. Thank you for joining me today. This is the weekly live stream where we talk about private equity and other more high-level business concepts. So, special shout out. If I could talk today. I don't think I can, but I'm going to try to anyway. Special shout out goes to my YouTube channel members. You guys are awesome. My Patreons, my super thanks donors, and of course to you. Thank you for being here and watching this, especially this rather remote topic. This is not kind of a mainstream topic, but I like talking about it. Anyway, this is basically a Q&A, but I'm going to talk about something first, and that is going to be the title of today's episode, which is Acquisition. This is episode 13 of Private Equity Rundown, and what we've been doing for the last several episodes is we've been going through the 7 steps of private equity, where a private equity firm buys a business, okay, and what that process involves. And there's 7 steps, and we've been covering them in turn, 1 step per episode. So there are 7 stages. We started with target identification, okay, so the private equity firm is going to look to buy a company. It's going to try and find a company to buy. Number 2, we talked about due diligence, right? Checking everything out. We talked about number 3, valuation. So placing a value, essentially a dollar value on the company that they're going to buy. Number 4, negotiation. So once you figure out what it's worth, then you enter into a deal and negotiate that deal. We talked about that last week. And that brings us to step 5, which is acquisition, which we're talking about today. This is where the private equity company actually buys the target company. Okay, so we're going to be talking about that process and what's involved in that process, where the ownership actually changes hands. So some of the mechanics of that. So you know what? Let's just dive right into that today. I made myself some rough notes that are probably terrible. That's a grand tradition, by the way. I'm terrible at writing down stuff that I will then work from later. Unfortunately, most of the work that I've done, and I've done from my entire career, involves this, but for some reason, I don't seem to be too effective at doing it. So I'm going for my rough notes here. Acquisition is where the private equity firm takes control of the target firm. So we talked about the negotiations last time. This is where the transfer of ownership takes place, and all the things that they've agreed to do actually are put into motion. So last time, for example, we were talking about various deal points. We're talking about, the means of financing, whether it's debt or equity, shares, or other more complicated things like taking funds and putting them in escrow and things like this. So this is where it's actually going to take place. Okay, so as you can imagine, this is rather a complicated phase where you have multiple things all going on at the same time. You got the financial things going on, you got the legal things going on, you got some operational and practical things going on at the same time. Multiple parties all involved in this weird kind of matrix. It can be a bit chaotic in the real world, okay? The timeline for actually doing an acquisition, once both parties have signed a deal, is about 4 to 8 weeks, somewhere in there. Okay, so 1 to 2 months. But the thing is, there is a component here of regulatory oversight. Whether you're doing this in Canada, where I am, or the United States, or in pretty much almost every other country, as I understand it, there's going to be some element of regulatory oversight. Usually there are laws connected with, people buying ownership in businesses, right? As you can imagine. There are some things that maybe a country might not want to do. Like, for example, let's say in the defense industry, you have arms manufacturers or something. Would you allow a foreign country to own 100% of your arms manufacturers? Probably not, right? So there's laws governing what's allowed, what's not allowed, and how you do things. So just like business is governed by that. Now, where I am in Canada, basically you've got a law called the Corporations Act, and that governs how businesses are allowed to function, right? Like what they're allowed to do, what they're not supposed to do. Now, when you do this kind of stuff where you have transfer of ownership, and investment stuff and securities, that's like a whole other act, a whole other set of laws, right? And it includes what we were just talking about, maybe foreign security concerns, right? So I'm going to briefly go into how that works in Canada and the US. So the point I'm trying to make is that when you're talking about the timeline, normally it takes 1 to 2 months to complete a transaction and actually transfer the ownership of a business properly. You have to allow sometimes up to 6 months extra time for regulatory review and oversight if it's a complex deal or if it involves particular industries where that's really scrutinized, like in the defense industry and things like this. So it can take more than 6 months, depending on what we're talking about. Okay, so the actual acquisition, it involves the financing side. So this is where you actually have to secure financing. So, you talked about how you're going to pay in terms of equity and debt. Now you've actually got to put your money where your mouth is and actually make the transaction. Okay, so if you're paying with debt, you have to actually secure those loans and things like this, and they have to be secured against the business's assets and all that kind of stuff. You have to actually put that into place. And as hopefully everybody knows, when we're doing these things, debt, it amplifies the payoff, it amplifies the terms, but it adds risk. So it's a trade-off. And private equity firms are known for using a lot of debt when they make acquisitions. So they borrow most of the money, buy the company, and the loans are secured against the assets of the company. The company itself that you're buying, the things it owns, like buildings and equipment and stuff, that's used as collateral usually in these type of debts. Okay, so you've got that whole thing going on. We talked about the regulatory stuff. So in Canada, I don't know if anybody cares, but in Canada, you have something called the Investment Act, okay? And that applies for key sectors like defense and things like this. And the idea is that it's supposed to benefit, you want to make sure that it does benefit Canada, either economically or in terms of security, right? And in Canada, that's overseen by a governing body called the Innovation, Science, and Economic Development Canada. So ISED. Now in the States, they've got their own version of that. That's called, it's called CFIUS. I don't know how you pronounce that. CFIUS, I think. Anyway, it stands for the Committee on Foreign Investment. Okay, so that's what the act is. Okay, so it checks national security risks from foreign deals, right? So you can't. I'm sure in the U.S. they would not want China to come in and own all their arms suppliers and all this kind of stuff. Strategic defense stuff. Things like this. There's stuff in there also for real estate, right? I don't know if it varies state by state. I think some things do, but I do think there's an overarching federal thing that regulates that too. Right? So you can't have just anybody coming in and like owning different parts of your country, maybe critical things that you rely on for defense, or critical things that can affect the entire economy as a whole, right? So there's some rules on that. I think it's a good thing. I think all countries should not just allow anyone in to do whatever they want. I think that there should be some responsibility there for what that's worth. So you've got different things going on. I don't know what I should talk about first here. Let's talk about the steps to do this. Okay, the actual acquisition. Okay, so first of all, you finalize the deal. That's what we talked about last time. Okay, so both parties sign the required documents. Okay, warranties, conditions, that kind of stuff. Okay. The closing logistics are set. So all the escrow terms and all that kind of stuff that you did, where you were arranging fund transfers, you're arranging for third parties to take sort of possession of funds and keep them in escrow, all this kind of stuff. You put all that into effect, and then the ownership itself has to legally transfer. And there's a couple of different things you have to do for that. So you're going to be signing documents, okay? Signing transfer documents and registering ownership changes with the authorities. The authorities in Canada will be the federal government and the provincial government. In the States, it'll be at the federal level and at the state level. Okay. And there might be other things in there, like, for example, with the land titles office and stuff like that. If the business you're buying owns land, that land is registered with the land titles office. They know who owns what. So obviously you're going to have to like change it there also, right? And then you pay various fees and taxes to ensure that those things go through. Those changes go through. Okay. The other element of this that can get quite complicated is that if there's a large amount of shares changing hands, you can get securities regulators involved if that's the case. So in the States, you have things like the SEC and stuff like that. That applies to this if you have large numbers of shares and other securities changing hands in the process. Okay, so that's pretty much the process. Unlike last time, I'm not going to go on about this stuff at length. I'm going to open it up to questions. If anyone has any questions, there really isn't too much going on with this. Once you've done all the previous steps, this step, relatively speaking, is, despite the chaos involved, it goes relatively smoothly, relatively quickly, because everybody's already on the same page, and this is more of a mechanical transaction that then has to occur. Annie 2385 says, can you talk about impact on employees in dealing with ambiguity during the post-acquisition? Okay, well, like we're doing here, I am talking about acquisitions done by private equity firms. Okay, so that's like one specific type of acquisition. Now, you bring up a good point, and maybe we should do a whole episode on this at some point. But see, private equity firms, you can get good ones and you can get bad ones. But basically, a way to think of it is they come in and they flip businesses. Okay, so, they do a lot of things that in themselves, they're not bad, but when you put all of them together, it can be regarded as bad because basically it reiterates the whole point of business, which is to make money. And they come in and they're going to make money. And, caring about the employees beyond their role in making money for the business really isn't part of this and hasn't been part of the culture, right? So, for example, they will come in and their goal is to improve the performance of the business. And they don't care about any personal issues because these are new owners in charge. And they don't have the history that the old owners might have had. So the old owners, they might have had personal relationships with a lot of the key employees. And I mean, just having been sort of involved with this stuff, like, for example, you may have had a department or something or a group set up under some initiative from the old owner. And it was an attempt to do something. Okay, maybe it was set up as like, okay, we don't know what the future holds. Maybe this industry could end up going this way or that way. We don't really know. So we're going to cover our bases by setting up, say, two departments. This one will deal with if the industry goes that way, and this one will deal with if the industry goes this way. Whichever way things go, we're going to be prepared because we've got people sort of working on both, right? So that's the idea. Now, so far, maybe it turns out that the industry is going this way. Okay, that's what seems to be happening, right? So you've got a group sort of dealing with that sort of thing, and then you've got this other group over here, and right at this moment, they might not be profitable, okay? Because they're more of a contingency plan. They're more of like a, risk management type thing. So if it turns out that this thing over here becomes a big trend, we're prepared for that. We're positioned for that to lead the charge on that. So we've set up this group here. But as of this moment, that group is not actually profitable. It's not actually bringing in a ton of money because it seems like very much this thing is really what's catching on. It's the direction that the industry is going. So for example, let's say you get bought out by a private equity company. They look at everything that you're doing. And one of the things that they're going to be doing is they're going to be assessing, every department, all the things that you're doing under the hood. In themselves, are they paying off? Are they making money? This thing is not making money. This was set up as some kind of weird contingency in the past, but so far it hasn't paid off. Okay, let's get rid of that, right? So, they're coming in with that attitude, and that's how their attitude is going to be different from maybe the previous owners. So if you're an employee in this group, obviously that's going to affect you, right? What I think is the way to do, and what some people do, is they try and transfer everyone out of it and reallocate them as much as humanly possible and accommodate them rather than letting them all go and then having to hire more people 2 months later because you're growing or something. You know what I mean? I try to, obviously it's preferable to do that. It doesn't take a genius or a visionary to tell you that. But the problem is like a private equity firm that's in charge of a target firm now, they're going to be thinking like that. And that's the problem. They are in this business to make money. That has to perform better for them than the company performed for its old owners, because the private equity firm paid a premium to buy it from the old owners. That's the idea. Just like if you buy a house and you flip it, presumably you're hoping you can sell it for more than it would have sold without all the lipstick and mascara that you put on the house, all the cosmetic changes or whatever you did to it. You know what I mean? So that's kind of the general situation. You know what I mean? So every time there's an acquisition, there's going to be some employee turnover. A lot of employees are going to leave. Sometimes the private equity firms really don't help their cause by doing business the way they do. Like, for example, instead of like coming in and trying to reassure everybody and say, this is what we're doing, instead, they come in, they intentionally keep everything secret until the last possible moment, and then bam, there's big changes, and they really don't care, at least in my experience. I mean, maybe I shouldn't say this as a blanket statement, but just take it with a grain of salt. They really don't care about people at the worker level. They care about sort of senior management people if those people have helped build up different areas of the business. So they don't necessarily want all those people to leave, and they don't want major disruption. But they're not really looking out for the interests of employees. All they're looking out for is their bottom line. And if they can come up with a plan that, looks out for the employees and the bottom line and utilizes the employees properly, all the better. You know what I'm saying? Anyway, I don't know if that really answers your question. It's a very general question, but that's for the specific case of a private equity firm. In general, if you're being acquired by another company, it could go this way, or that other company could take a very different attitude towards it. One example is when they try and keep your company completely untouched, essentially. They're just like a subdivision of the new combined company. I've seen that before. I've worked for companies like that. Or if they want to totally assimilate it into their combined company and completely change everything that you do and the way you do it. I've been a part of that before, where my company was acquired by a larger US company. And, that's what they did. They came in a sort of very arrogant way and said, everything's going to change, which is kind of weird, because in one sense, the reason why the target company was so attractive is because they had built it up. So you build it up and you want to buy it because it's successful. But then the moment you get it, you just decide to tear it completely down and change everything about it. It's like, in many ways, you're throwing away the advantage. So, it's also well known that a lot of these deals, they're not as successful as they're promised to be. A lot of people make a lot of money speculating on things in the beginning, but in terms of actual economic value that's generated, a lot of them are not that successful, so that's the irony of this stuff. Anyway, that was a good question. If we could get more questions like that, I see there's 19 people here. It would be interesting to talk about. See, for me, mergers and acquisitions is actually a really interesting topic. And it's probably the epitome of boredom for some people, but no, it really is, because it cuts right to the issue of, what a business does, what its purpose is, and what's the best way to run it. How do you measure its success? It really brings to light a lot of those key fundamental questions that you can easily forget about when you work in business, because you've been doing it so long, you sort of don't see the forest for the trees, You know what I mean? So it really brings a lot of those issues out into the open again. Things that maybe the original owners haven't really thought about properly for a very long time, because they're so used to doing things one way and not questioning different aspects of how everything's set up, It's interesting how, people build things in many ways. They build things in their image. They have certain opinions about how things should work. So if you're in a position where you can build a business, you've discovered a way to create value and you're exploiting that, you build it the way you think it should be run and it should operate. But then when you get something like a private equity acquisition, you get private equity companies coming in, they don't care. They don't have those opinions. The only opinion they have is, we want to make more money. So they don't really care what they do as long as it makes more money. So in a way, it's kind of like, this sounds like a good thing, but I don't mean it in the good thing. They're liberated from, constraints that maybe a original business owner or business founder might have been under, And when you sort of lift all those constraints and now you can do anything you want, it creates a lot of disruption. And a lot of it is not for the better, because you've got the finance people in charge, and the finance people like to think they have the answers for everything and they see the bird's eye view, but a lot of times they don't, They see the bottom line, but in terms of how to make the money, how to influence the bottom line, they don't know as much as they think, in my experience. Anyway. Well, there's no more questions. That was actually a really good question. I was hoping we could get more of those, but yeah, like that's something I would definitely love to talk about more. And what I'll do is I'll structure my thoughts a bit better before we have one of these, and we'll do an episode on it. The bottom line is that if your employer is, there's going to be a change of ownership. If that's all you don't know any of the details. There can be a lot of disruption for a lot of people. Some people like to come in and change almost nothing. Other people like to come in and change everything, and you really don't know unless you do some research on the acquiring entity. What's their history? What do they do? And if it's a private equity firm, they'll come in and they'll do a ton of stuff. There'll be a lot of changes on day one. They'll come in and they'll make a lot of changes, just right off the hop. That's usually a staple of how they behave. And their goal, basically, just so everybody knows, their goal is to essentially flip the business. So they're going to hold on to it for a couple of years, maybe 5 years, something like that, and then sell it. And then the idea is that they're hoping they can sell it for much more than they paid for it 5 years ago. That's the idea. Alex is there. Says, "Hey, bro, how are you?" I'm doing fine, bro, and it's nice to see you too. Thank you for being here. Yeah, I've said all I had planned to say about acquisition. So unless anyone else has any questions, Well, thank you, Alex. I don't know if are you here for the private equity discussion? I don't know if you know what private equity is. That's when one company buys another and then flips it. That's the idea. So I've been doing this sort of experimental live stream for the past several weeks because I'd like to talk more about this stuff. And we've been going through all the stages of private equity. And somebody just asked a really cool question about how this affects employees and stuff. And that's a great area to explore. And maybe something I would love to talk about that more in the future in a more controlled way. But yeah, if you want to learn business with me, you want to learn about this stuff, how it all works, check out that course. Where you learn about this in business school is basically in the study of finance. That's where all this stuff is lumped, right? So finance is the study of money in the future, just if everybody knows. Accounting is the study of essentially money in the past, where the money went, what happened, did we make a profit? Those kind of questions, right? How much fees did we pay? How much taxes did we pay? Where did the money go? That's all accounting, right? Finance is about money in the future. What should we do? Should we do this? If we're going to do this, how can we raise money for it, right? What's the risk of doing something? If we do this, what are we expecting to happen? What's the chances of having a certain payoff, right? So if you study something called corporate finance, which is part of finance, they talk about stocks, like shares and options and derivatives and all that kind of stuff. And then that moves into a discussion of like buying and selling companies, right? Like M&A, mergers and acquisitions. So that's where you study this stuff. That's where this stuff is taught, right? It's all kind of a subset of finance. So, it goes into the acquisition of companies from a financial point of view, taking ownership of it, the financial performance, why you would want to do it, because it's purely tied to some kind of financial performance, right? They do talk about M&A to a degree in things like marketing or operations, but really not. Like they talk about the implications of it, but they don't talk about actually doing it, like how you would do it, how you would go about doing it. They just sort of examine sort of artificial case studies of if you were to combine your company with another one, then how would it change the marketing, in terms of getting market share and stuff. But they don't really talk about M&A in itself, how you would do it, and if it's a smart thing to do. So that's really reserved for finance. So that's where you study this stuff. So if you want to learn about this stuff and how it works, that's what you would study. You would study finance. So if you're looking to study finance, that's a component of business. Check out that course right there, and you will learn what you need to. What you could even do with that course is you could just, if you really wanted to, you could just take the finance component of it, okay? And you could go deep into the finance side. You could talk about, there's many different topics within finance. Like for example, sort of commodity markets and, the stock market and all that kind of stuff. Investment in a portfolio of different things like securities. What type of securities? You have bonds and stocks and options and, different other types of derivatives and stuff in there. Like how all that stuff works, understanding Wall Street, essentially, like that's all that business, right? But understanding like foreign exchange, like the dollar is trading versus the yen or the yuan or, the pound sterling or, like all this kind of stuff, how that stuff works. That's like foreign exchange and in a sort of globalized market. There's many different areas of finance, even things like startup financing, like term sheets for what they do in Silicon Valley and all this kind of thing. Sort of risky tech investments, different areas like that. So what you could do is you could just take the finance component of an MBA or that MBA and then just go deep into different areas of finance or one area that you're particularly interested in, because M&A is one of those, mergers and acquisitions. Alex says, what is acquisition? Acquisition is when one company buys another. So one company ends up controlling and owning another company, right? That's what that is. Acquisition. A merger is exactly the same thing, except that it's two companies that are about the same size. So if this one, company A, buys company B, they form a new company that's like sort of 50% A and 50% B, right? But if it's an acquisition, what they're talking about there is when a big company buys like a small company. So like the big company just absorbs it. Company B ceases to have the old name. It ceases to be its own thing. It just becomes a part of like the giant company that bought it, right? That's an acquisition. So what I talk about in this live stream is one particular type of acquisition. It's done by a certain type of company called a private equity company. And private equity companies, they're in business. All they do is they buy companies, they mess around with them, essentially try to flip them, and then sell them. So they're not in the business of holding on to these companies for the long term. They just see something, they buy it, they mess around with it, see if they can get it to be more profitable, and then sell it, and then that's where they make their money. And they just keep doing that, right? So that's how those work. Alex says, bro, I use your videos to learn English. Haha. Yeah, haha indeed, because I don't know how good my English is. Yeah, that's interesting. Let me know how effective that is with my bastardized pig English that I use. Slurred as I do with colorful expressions. But hey, whatever, if that's working for you, hey, why not, As long as you're getting something out of it. Okay, in half an hour, I'm going to be back with my regular live stream on Fridays, Honest HR Nitrous, where we talk about getting a job, right? Job search, how to get a job. If you're trying to get a job and it's not working, what's going wrong? What should you be doing? How that stuff works. So we're coming down from the high level down to the sort of the low level and talking about that. So that starts in about half an hour. If anyone has any questions about private equity, speak now or forever hold your peace. I will stay if there's any questions or intelligent questions. If not, I'll just wind this down. That's okay. And I'll be back in like 20 minutes or whatever it is. In the meantime, if you want to learn business, you want to learn this stuff, check out that course. There's a link in the description. Very popular course. Tremendous bang for the buck. If you want to learn business, like you want to learn the concepts so that you can apply them and they will benefit you directly, either in a conventional career where you outperform in your current job and go for promotions and things and climb the ladder. Or you want to learn how to build businesses, like you want to be an entrepreneur, someone that understands how to make money directly, right? Without needing an employer that, you have to go through to make money. You understand how to make money yourself directly by the things you do, where you make sales, right? And you stumble upon something like really amazing. If that's what you're looking to do, either a startup or a conventional small business, hey, learn business, right? Learn your craft. This stuff is really cool. It's the tools for empowerment. You don't have to be a wage slave your entire life. You can make money directly. If you've got your own ideas and you've got talent, and you want to do your own thing, you can do it, right? In the beginning, you can do it as a side hustle. That's what I recommend. I do a live stream on Mondays called Side Hustle Ideas, where I encourage people to do side hustles, because a side hustle, you don't have to quit your day job to do a side hustle. It allows you to learn about this stuff and get experience and try things. And if you stumble upon something that shows a lot of potential and you have money coming in on the side, then you have the option, if you want, to take that to the next level. You could make that your full-time thing and make your fortune doing that, and you don't need to go cap in hand to an employer and work under their thumb according to their rules. You can do your own thing. So I think it's an incredible thing. I encourage people to learn about that in a sort of risk conscious way. Don't take major financial risks with your life. You don't need to, if you know what you're doing, you can experiment and figure stuff out on the side. And then once you hit upon success, and it's confirmed, you've got a lot of money coming in, then you can decide to take the next step if that's the way you want to go. So I encourage people to do this. But it starts with learning business. It starts with learning the principles. Alex says, do you speak British or American English? Well, kind of, I'm in Canada, so it's kind of like a bastardized halfway house of both of them, right? I'm not in the UK. I'm in Canada. I have a Canadian accent, right? You can tell by the amount of times I say, how's it going, eh? And I got my hockey stick and my toque and my dog sled outside. That's the weather outside, right? It's the Arctic. And we all live in igloos and take the dog sled to work. And in my spare time, I dress up like I'm in the Royal Canadian Mounted Police, you see? That's what we all do up here. So yeah, but I don't speak American English. I speak Canadian English. So a lot of people can't tell the difference. But that's okay. Anyway, I'm probably going to wind this down. Thanks for being here. There's 20 people here. You guys are awesome. And I will be back next week at the same time with another episode of this, where we're going to be covering the next step, which is post-acquisition improvements. This is the interesting part. Once a private equity firm has actually bought a company, what they do to it, that's the kind of interesting part. What things do they pretty much always do? Why they do them? How effective they are? That's kind of finally where it, for me anyway, it gets interesting. So tune in for that. I will be back in 15 minutes, or we'll talk how to get jobs. Other than that, you guys are awesome. Take care of yourselves. Have yourselves a great weekend, and I'll see you soon. Bye for now.